Welcome to Day 19 of Future Business School's Daily MBA series. Today, we're diving into Managerial Accounting, which focuses on providing financial information to managers for decision-making within a company. This contrasts with Financial Accounting, which is aimed at external stakeholders. Key topics we'll cover today include costing methods, break-even analysis, and budgeting. Let's get started. What is managerial accounting? Managerial accounting provides the financial data needed for internal decision-making, allowing managers to plan, monitor, and control operations effectively. Unlike financial accounting, which adheres to standards like GAAP or IFRS, managerial accounting is flexible, adapting to the company's specific needs. It provides insights that help managers with pricing, budgeting, and profitability strategy. Step 1. Costing methods. Understanding costing methods is fundamental for managers to determine how much it costs to produce goods or services. This information helps with pricing, budgeting, and profitability analysis. There are several costing methods used in managerial accounting. 1. Job costing. Job costing assigns costs to specific jobs or batches of goods. This method is common in industries where products are customized or produced in small batches, such as construction or consulting. In job costing, labor, materials, and overhead costs are tracked for each job. For example, a custom furniture maker uses job costing to calculate the exact cost of materials, like wood and varnish, labor hours, and overhead, like equipment depreciation, for each piece of furniture produced. Process costing is used in industries where products are mass-produced and the costs are accumulated by process or department. The total cost is then averaged over all units produced. This method is common in industries like chemicals, petroleum, and food production. For example, Coca-Cola uses process costing to calculate the costs of producing thousands of identical bottles of soda. Costs are divided across production processes such as mixing, bottling, and packaging. Activity-based costing allocates overhead costs based on activities that drive costs, such as machine setups, quality control, or product design. ABC provides more accurate product cost information by tracing costs to specific activities and processes. For example, a tech company like Dell may use ABC to allocate indirect costs like IT support, office maintenance, and marketing to specific activities like product development or customer service. Break-even analysis helps businesses determine the point at which total revenue equals total costs, meaning the company neither makes a profit nor incurs a loss. It's an essential tool for understanding how many units need to be sold to cover fixed and variable costs. Key formula: break-even point in units equals fixed costs divided by price per unit minus variable cost per unit. Fixed costs: costs that do not change with the level of production, such as rent and salaries. Variable costs: costs that vary directly with production levels, like raw materials. Price per unit: the selling price of each product. Example: let's say a coffee shop has fixed monthly costs of $2,000 and each cup of coffee sells for $5. The variable cost per cup, which includes beans, milk, and so on, is $2. Using the formula, break-even point equals 2,000 divided by 5 minus 2, which equals 667 cups of coffee per month. This means the coffee shop needs to sell 667 cups per month to cover all its costs. Step 3. Budgeting. Budgeting is a crucial aspect of managerial accounting, allowing managers to plan for future expenses and revenue. It's a tool for allocating resources efficiently and setting financial goals. First, the operating budget. The operating budget focuses on the company's day-to-day operations, estimating revenue, expenses, and profit. It includes sales, production, and administrative expenses, providing a roadmap for business activities over a specific period. For example, A retailer may prepare an operating budget that forecasts sales for the holiday season, ensuring they have enough inventory and staffing to meet demand. Next, the capital budget. The capital budget outlines planned investments in long-term assets, such as equipment, buildings, or new product lines. It helps businesses decide which projects to undertake and how to finance them. For instance, a manufacturing company might use a capital budget to decide whether to invest in new machinery that will increase production capacity. Finally, the cash flow budget. The cash flow budget tracks the company's expected cash inflows and outflows. It ensures that the business has enough cash on hand to meet its obligations and avoid liquidity problems. For example, a startup might create a cash flow budget to ensure they have enough funds to pay salaries and rent while waiting for customer payments. Real-world application: Tesla's managerial accounting practices. Let's take a look at Tesla, a company that effectively uses managerial accounting to make key decisions. Costing methods. Tesla uses a combination of job costing and process costing. For example, job costing might be used for custom orders of their solar panels, while process costing is used for their mass-produced electric vehicles. Break-even analysis. Tesla likely conducts break-even analysis to determine how many electric vehicles they need to sell to cover their substantial fixed costs, like factory maintenance and R&D expenses. Budgeting. Tesla's capital budgeting plays a crucial role in their decision to invest in new gigafactories and battery technology, which are essential for their long-term growth strategy. Conclusion and key takeaways. Managerial accounting plays a vital role in helping managers make informed decisions about costing, pricing, and resource allocation. Whether through accurate costing methods, break-even analysis, or effective budgeting, managerial accounting provides the insights needed to optimize operations and improve profitability. Key takeaways: costing methods, job costing, process costing, and ABC help track production costs and improve pricing decisions. Break-even analysis provides a clear view of how many units a business needs to sell to cover costs. Budgeting helps businesses plan for the future and allocate resources efficiently. Thanks for watching. Make sure to like, share, and subscribe to Future Business School for more business insights. In our next episode, we'll cover cost volume profit analysis, an extension of what we discussed today.